So now we need to take a look at some other tax laws that affect owning real estate. And we start here looking at some tax breaks for homeowners, hopefully some ways you could actually reduce some of the taxes you might owe. And now when I say taxes, income taxes, these are tax breaks. But the first one here is mortgage interest can be deducted. Obviously we don't like paying interest, and we certainly don't like paying much interest if we got to pay any at all. But the good news is at least the interest portion of your payment is tax deductible. And it says here you can deduct up to $1.1 million in total. Okay, now we need to break that down a little bit, because you'll notice in that first bullet it says you can deduct up to $1 million in acquisition debt. And by the way, it says on the side here per year. That's I need to correct that, and I apologize for that, but I just noticed it. But no, this is over the term of the loan itself, not just per year. But anyway, so you can deduct up to $1 million in acquisition debt, again, $1 million in interest. And now when talking about acquisition debt, here they're talking about on the money you initially borrowed to purchase the property. So if you paid $300,000 for the property, the interest you paid on that $300,000 is deductible up to $1 million. And then the second bullet, what it's saying is you can deduct up to $100,000 of interest on any equity debt. So for example, if you take out a home equity line of credit, then you can deduct up to $100,000 in interest on your equity debt. So between those two, that's a total of $1.1 million that you can deduct over the course of that loan. And good chance they'll ask you about that. So you need to understand how the mortgage interest deduction works. And then at the bottom of this slide, again, also in your book, but you can also deduct property taxes. So, if you're paying $1,000 a year in property taxes, again, nobody likes it. But the good news is you get that back. You can deduct that from your income before your income taxes are calculated at the end of the year. Okay, so that's a couple tax breaks. But another tax break is something called the homestead exemption. Now, the one we're getting ready to talk about right now applies obviously to South Carolina. I'm sure most likely every state has some sort of homestead exemption, but they don't necessarily all work the same way it does here in South Carolina. There could be some differences. But the good news is we're in South Carolina, and so this is the only one we're concerned about right now, the only one to be tested on. So this is how the homestead exemption would work in South Carolina. First of all, for those that qualify for this exemption, you get to deduct $50,000 from your home's value before your property taxes are calculated. Now, y'all, that's pretty strong. Excuse me. That's pretty strong right there. So if your house is valued at $200,000, you get to deduct $50,000 from that. So you're only going to have to pay taxes on $150,000. In fact, I'll also tell you, because of this law, y'all, there are a lot of people in South Carolina that pay no property taxes because their home may not appraised for more than $50,000. So if your home is only worth, say, $50,000 or less, then you pay no property taxes at all. So that's pretty cool for those that qualify. So now we take a look at, well, then who does qualify for the homestead exemption? Now in your book, you see several bullets there, and I certainly encourage you to read them and get familiar with them. But at the end of the day, it's really three things that could qualify you for this exemption. And you need to remember these three for sure. You got to be at least 65 years of age or older, or totally disabled, or legally blind. Now, notice it kept saying or, because you don't have to meet all three of these. If anyone meets any one of those three, 65 years of age, totally disabled, or legally blind, then you qualify for this exemption. Now you will have to, there's an application you'll have to submit. There's really not much to it, but you'll submit it, and then you get $50,000 off your property's value before you pay property taxes. Now, and then that last bullet, it does say, obviously, to take advantage of this homestead exemption, you have to be a resident of South Carolina. So if you don't live here, you're not going to get it. But you got to be a resident of South Carolina for at least one full year as of December 31st. So if you've been a resident for more than 1 year and you meet one of these three requirements, then you qualify for this exemption. Now, I've also had people ask me for some reason, well, I'm a disabled vet and I'm 90% disabled. Does that qualify? Okay, well, what does totally disabled mean to you? Okay. No, 90% won't do it. If you're totally disabled, then you qualify. So I just wanted to clarify that one, just because I've had so many people ask me about it. All right. Another potential tax break is something called discount points. Now, we're actually going to talk more about discount points again when we get into chapter 5, which is the finance chapter, because that's what we're really dealing with here. But what are discount points? Well, discount points is really a way that you can actually buy down your interest rate. So, if the lender says the interest rate 6%, I'm making up a number obviously, 6%, you could buy discount points, and obviously the more points you buy, the lower your interest rate would come. So you're buying down your interest rate. So a couple things we need to understand about that. First of all, how much does 1 point cost? Well, 1 point costs 1% of whatever the loan amount is. Okay? So if I'm borrowing $100,000, 1% would be $1,000, right? And then for that $1,000, that would lower your interest rate, but how much will each point lower my rate? And that's the next thing you got to know. Each point will lower the rate by 1/8 of 1%. So if you wanted to lower the rate by 1/4%, then obviously you got to buy 2 points, right? And if the loan was $100,000, then how much is it going to cost to lower my rate from, to lower it 1/4%? Well, 2% of $100,000 would be $2,000. Okay, that's how that works. Now, I can promise you're going to get questions about this, and it'll probably be in the form of a math question. And where I see students make mistakes is, in the question, it'll say, just for example, again, we're going to talk more about this when we get into the finance, but I want to go ahead and clarify something here real quick. Let's say I'm buying a house for $200,000 with a 90% loan to value, which, and again, I know we haven't talked about any of that yet. That's coming up in chapter 5. But 90% loan to value, it means that the lender will loan me 90% of whatever the purchase price is, meaning I'd have to put 10% down. So if the purchase price is $200,000, 10% of that would be $20,000, right? So you'd have to put $20,000 down, so that means you'd be borrowing $180,000. So So $180,000 from the bank, $20,000 that you're putting down, that equals the $200,000 that you're actually paying for the house. Well, if they're asking you how much are the discount points or what do they cost, y'all, again, it costs 1% of the loan amount, not the purchase price. Be careful with that. If you use the purchase price and multiply that by however many points, you're going to have the wrong answer. Now, I'm sure they will have that answer there, and you'll feel very good about missing it because you came up with the same wrong answer they did. Be careful with that. So discount points, 1% of the loan amount. And we'll talk about how the loan amount's determined again in chapter 5. And then, one more time, each point will lower your interest rate by 1/8 of 1%. And then the last thing is saying here, and the reason this is a tax break is because and say you pay $2,000 in discount points. Well, what are these discount points? It's interest. It's basically it's prepaid interest. You're paying interest in advance. So because you're paying that in advance, the lender agrees to lower your interest rate by however much. Well, is mortgage interest tax deductible? Yes, we just got through talking about that. So discount points, because it's just prepaid interest, is also tax deductible. Now, I don't know if they'll get into this on the exam or not, but it is kind of important to understand this note. These discount points are deductible, but only by the buyer, regardless of who paid for those discount points. In other words, even if the seller paid for it, seller, you can't deduct it, but the buyer can. Even though somebody else paid for it, buyer, you can still deduct it if discount points were purchased. So, what we're really talking about here, it's not unusual, not in this market anyway. When a buyer, a lot of times, will make an offer on a house, they'll say, look, I'll buy your house for $200,000, but seller, I want you to pay $5,000 in up to $5,000 in closing costs for me. And that's not unusual for a seller to agree to something like that. Well, part of those closing costs might include these discount points. So in effect, the seller has bought the discount points for the buyer, which lowered their interest rate. But whatever the cost of the discount points are, they are deductible, but only by the buyer. Only the buyer can deduct discount points, again, regardless of who pays. All right, so this next tax law is a little bit, now this is not necessarily a good thing, I guess you'd call it. It's the capital gains tax, and and you need to understand at least the concepts behind the capital gains tax. But here's what we're dealing with here. If you buy your house, say for $100,000, and at some point in the future, no matter how long in the future you want to talk about, but at some point in the future, I decide to sell my house, maybe because I'm buying another house, moving or whatever, but I sell it for $150,000. Well, you just made $50,000 on that sale, right? Because you only paid $100 and you sold it for $150. That's $50,000. That could be considered a capital gain. So the point is, if you make money on the sale of your property, guess who's going to want some of it? The government. And they call that a capital gains tax. Real estate is considered a capital asset. So if you sell a capital asset and make money on the sale, then you will have to pay taxes on that gain. They call it capital gains tax. Tax. So how do these capital gains taxes work? Well, you see some terms right here, and you're going to see how we use them here in just a second. But the first thing you see, there's something called the basis. Y'all, the basis is whatever you paid for the property. Y'all, when you initially bought it, whatever you paid for the house or property, that's your basis. So if you bought it for $100,000, then your basis is $100,000. Y'all, that's kind of like the starting point. But then it talks about the adjusted basis. You know, there's a couple of things that you could potentially do during the time that you own the property to actually increase your basis. And I will tell you, y'all, anytime you can legally increase your basis, y'all, anytime you can make it go up, that's a good thing for you as a taxpayer, as you'll see here in just a minute. But I'm going to tell you, y'all, there's only two things you can do legally to cause your basis to go up. One of those would be closing costs that you incurred when you purchased the property. So again, you bought it for $100,000, right? And say you had $3,000 in closing cost to purchase it. So you can add that $3,000, those closing costs, to the purchase price. So that would increase your basis now up to $103,000. But another thing you could do to increase your basis would be any capital improvements you make to the property, again, during the time that you own the property. Now, what's a capital improvement? Now, I want to tell you, that's a question that you and I will not be able to ask. Will be able to define with absolute certainty. Y'all, there's so much confusion right here. Y'all, I'm telling you, I've talked to many CPAs, y'all, accountants about this. If I do this, is that considered a capital improvement? Y'all, about half of them will say yes, it is. Another half say no, it's not. So all I can tell you is, y'all, you better hope you got a good accountant. And why this is so confusing, honestly, I'm not sure. Because when I read the verbiage in the tax code, y'all, to me, it actually sounds pretty clear. I don't get confused until I listen to all these accountants start talking. Then I get confused. But basically, y'all, what the tax code is saying is this: a capital improvement is any addition you make to the property. Y'all, basically it has to be an addition to. Something you do that's considered an addition to. Y'all, for example, and I don't think anybody would debate that this is a capital improvement, but let's say I had a 3-bedroom, 1-bathroom home. But I decide to add a second bathroom. Well, y'all, that's clearly an addition. Y'all, so I've added to it, right? So that would be considered a capital improvement. So y'all, say I spent $20,000 adding a bathroom. Then I could add that $20,000 again to my basis, which would again make my adjusted basis now goes up. So any capital improvements you make to the property, you can include that. But now I will tell you, you have to, any improvements you intend to count towards adding to your basis, you've got to report that in your tax return, your income tax return at the end of the year. You got to put in there that, what was the improvement you made and how much was it? If you don't put that in your tax return, you're not going to get this added to your basis, okay? And I'm telling you, you want that basis to go up, so you better take advantage of it and report those improvements as you do them. And then you see, the next term here you see is the amount realized. The amount realized is once you actually sell the property. Let's say I sold it for $150,000. Well, that was the sales price, but that's not the amount realized, because the amount realized is how much did you actually put in your pocket at closing. Because not only did I'm selling it, but now I got to pay closing costs, which includes realtor fees, commissions, and stuff like that, and say I paid $10,000 in commissions and closing costs and whatever, then my amount realized was actually $140,000. So I sold it for $150,000, but with the closing costs and everything else of $10,000, then I only realized $140,000. Okay. And then lastly, the last term you see there is the gain. Y'all, the gain is what you owe taxes on. And to figure out what the gain is, you just take your amount realized. Y'all, in this example, I said it was like $140,000 minus your adjusted basis. Y'all, whatever that amount was. And that's why it's important to keep adding to it. But you subtract your adjusted basis from your amount realized, and whatever's left, y'all, that's your gain. And that's obviously what you would owe taxes on. Now, I've got an example here, and some of the numbers here are pretty close to what I was just talking about. But if I purchase the property for $100,000, I have closing cost of $3,000, then my adjusted basis is $103,000. But then I sold the property for $130,000. I had $9,000 in selling expenses, y'all, commission, closing costs, and whatever. So my amount realized here is $121,000. So what was my gain? How much did I make on owning this property? Well, the amount realized, $121, minus the adjusted basis of $103, gives me a capital gain of $18,000, y'all, in this example. Now, y'all, look, there's a lot more to this than what we just covered. The good news is that's all you need to understand for test purposes. Again, we're not accountants, we're real estate agents. Obviously, should you ever start trying to tell your buyers or sellers how much their capital gain tax is going to be? Y'all, no. Y'all, you're not an accountant. Are you crazy? Don't even go there. They need to talk to their accountant. Figure out what kind of tax liability they'll have for buying and or selling real estate. But that's what you need to understand there. All right. Now here's some good news about the capital gains. Y'all, there are some significant exemptions, which would, for those that are exempt, may not have to pay any capital gains. In fact, the way they've got the law today, not very many people would ever have to pay any capital gains tax. But what it's saying right here on this slide, if you own your property and you're the sole owner, y'all, nobody else owns the property, you're the only owner, then you get a $250,000 capital gains exemption. Y'all, meaning as long as you did not make more than $250,000, then you owe no capital gains tax. Now, if you're married and you both own it, together, then you qualify for a $500,000 capital gains exemption. Y'all, that's $500,000. Y'all, look, if you sell your house and you make more than $500,000 on it, you ought to pay some taxes and help the rest of us out a little bit, shouldn't you? Y'all, that's a heck of an exemption right there. But the other thing it's also saying here, y'all, if you're married, and again, assuming you both own the property, you're both on title, y'all, some married couples will file one joint tax return every year, but some couples, they will file separate returns. Y'all, the wife will file her own return and the husband will file their own. Well, if you're filing separate returns, and again, you're both on title, then you both get a $250,000 exemption, okay? Each one of you would. But if you're filing one return, one joint return, then you combine it and get the $500,000 exemption that way. Y'all, hopefully that makes sense. Now, you got to qualify for this exemption. So how do you qualify? Or what are the requirements to qualify? Well, it says you must have owned that property for at least 2 years. So y'all, if you buy it and sell it in less than 2 years, you do not get this exemption. You will have to pay the capital gains tax. It also says you must have lived in that property for at least 2 out of the last 5 years. So you got to own the property and live in the property for at least 2 years. And then you qualify for the exemption. Now that last bullet, what it's saying here is, y'all, if you just lose money on the deal because you made a bad purchase or the market crashed and you couldn't sell it for what you paid for it, tough. That's what the IRS says. Y'all, you cannot write off the loss as a tax deduction. You can't do that. All right, so again, y'all, as long as you own the property and live in the property for at least 2 years, then you qualify for the exemption, and we just went over how much that would be. So that's pretty good. Y'all, this next tax law is something we call a 1031 tax deferred exchange. The 1031 exchange, you hear it called a lot. And y'all, first of all, these next 2 laws, this 1031 exchange, then we're going to talk about a delayed exchange. But y'all, these 2 laws were written for investors, okay? So if you're not an investor, meaning you just own the house you live in, then you know what, assuming you live there for 2 years, then you qualify for that capital gains exemption. But if it was not a property you live in, if it was a rental property or something, then obviously you would not qualify for that capital gains exemption because you did not live there. You were renting it out to tenants. Well, these next 2 laws were written primarily to help reduce some of that tax burden potentially for investors. And here's how they would work. Again, so the first one we look at, again, is the 1031 exchange. And really, I think it'd be easier to explain it if I just give you an example how this might work. Y'all, let's say I own 5 rental houses here in town. And y'all, just to make math simple, let's say all 5 of them are worth $100,000 a piece. So all 5 together obviously would be worth $500,000, right? Well, what I want to do is I'm looking for a vacation home. I'm looking for a property, a house, say on the beach, for example. And I'm trying to find somebody that currently owns a house on the beach that would be willing to just exchange properties. So let's say I find somebody and I tell them, say, hey, look, I got these 5 rental properties here in Columbia, and I'll give you all 5 of these rental properties worth $500,000 for your one house at the beach. And let's just say, for argument's sake, the house at the beach was worth $560,000. Okay? But I found somebody willing to just swap or exchange properties, because that's all we're wanting to do here. Well, if we do that in this scenario, would that be a fair exchange or an even exchange? No, not if you ask the guy at the beach. He's going to say, look, my house is worth $560,000. Your properties are only worth $500,000. So we're going to have to even up this exchange here a little bit because we're $60,000 difference here. Well, typically what we would do is, if I were the one with the properties in Columbia, then I would just say throw in another $60,000 in cash, y'all, just to even up the trade. Now, it doesn't have to be cash. Y'all, you can include anything of value that would even up the trade. Y'all, for example, maybe I got a motorhome that's worth $60,000. I say, you know what? I'll throw in this motorhome. It's worth $60,000 just to even up the trade. Anything you use to even up the trade, whether it be just cash or motorhome or whatever it is you throw in to even it up, Y'all, that's what we call boot. You really don't want to be the party receiving the boot. And here's why. Now, first of all, if we just exchange properties like this, y'all, how much money actually ever goes into my pockets? Zero. None. Because I didn't sell the property, I just exchanged. I swapped my property for another property. Well, what about the guy at the beach? How much money actually went into his pockets? $60,000. Y'all, the IRS says anything that's considered boot, y'all, anything used to even up the trade, that's boot, and that's considered pocket money. Well, that pocket money, that boot, whoever receives it will have to pay taxes on the boot, not the full value. So you wouldn't have to pay taxes on the $560,000, just the $60,000, in this example. But whatever the value of that boot is, whoever received the boot will have to pay taxes on that. But otherwise, there's no other taxes here because I didn't actually sell the property, right? I just exchanged properties and no money went into my pocket. So this tax deferred exchange is one way to get rid of one property without having to pay a capital gains tax on it, okay? Now, we'll say this. Y'all, this is not something that you could just do on your own. Y'all, by law, this is not an option here. If you're going to do a 1031 exchange, you must hire an intermediary. Y'all, somebody that does this for a living. You have to hire an intermediary, and they will have to process and handle this exchange on your behalf. You cannot do it yourself. Y'all, by law, the law requires there to be an intermediary, y'all, somebody working in the middle between the two, bringing all this together, okay? All right, so that's the 1031 exchange. And then the last one here is what we call a delayed exchange. Y'all, again, trying to help investors with potential tax liability. But this one works a little bit different. In fact, it works a lot different, quite frankly. But the way this would work is this, and I'll just give you an example on how this would work. Y'all, let's say I've got a rental house, a rental property. And what my goal or objective is here is I actually want to sell the property. Again, we're not doing an exchange. We're actually going to sell this property. But my intentions are I'm going to take the proceeds, the money from the sale, and I'm going to use that money to purchase another property in its place. So I'm selling one and using that money to buy another one in its place. Now here's how that has to work. And by the way, you have to have an intermediary to handle and process this transaction for you, just like the 1031. Again, it's not something you can do on your own. But here's how this law requires this to work. When you sell your property, now obviously the proceeds from the sale will be held by that intermediary. Y'all, you can't touch it. If you ever touch the money, in fact, most time we never even go to closing because, y'all, if you ever touch that money, if it ever comes into your possession, the deal's off. You now owe taxes on that money. Y'all, this is one reason why you have to have the intermediary. Y'all, somebody that can handle and, hold the money for you so it's not in your possession. But anyway, so the intermediary will hold that money. And then, y'all, now you have to look for another property. And now the law says it must be a like property that you intend to purchase in its place. Now, when we say like property, y'all, that's a little bit confusing right there. But I'll just tell you, y'all, for example, if it's a rental house, a single family rental house that I sold, does that mean I have to buy a single family rental house in its place? No, that's not what that's saying. Y'all, for it to be a like property, y'all, what the law is saying here, y'all, it has to be a property that's being used for the same purpose as the property you sold. So that rental property I sold, y'all, it was an income producing property, right? Which means the property I buy must also be an income producing property. So could I sell the rental house and buy maybe some type of commercial property? Y'all, as long as it's income producing, I could. So when it says it must be a like property, it doesn't mean a house for a house or trailer for a trailer or something like that. Y'all, it's how it's used. So whatever you sell or whatever you buy must be used for the same purpose of whatever it was you sold. All right. Y'all, anyway. So again, the way the law reads, from the time you sell your property, you now have 45 days to look for and identify potential properties you might be interested in buying. Y'all, and every time you find a property you think you may have interest in, y'all, again, you would notify your intermediary, and y'all, there's actually a form, and your intermediary will enter that potential property onto this form. But at the end of the 45 days, you're going to have to choose which property you're going to buy. And it has to be one on this list. Now, if you've only identified one property, obviously that narrows your choices down quite a bit. But at the end of the day, you're going to have to buy, if you only chose one, then you're going to have to buy that one property. But then it says you now have up to 180 days until you must close on that property. Now, we need to be clear here. Y'all, you do not get 45 days to find a property and then another 180 days until you have to close. Y'all, that first 45 days that you're looking for a property, that is part of the 180 days you have that's total. So basically you got 180 days in total from the time you sell your property till you must close on the property you're buying. If you don't do it within those timelines, again, then you're going to have to pay the capital gains tax. Now, the other thing that I didn't say yet, so let me say it now. Y'all, obviously, every penny that comes out of the sale of the property you're selling has to go into the new property. Y'all, you cannot keep one penny out of the sale. So obviously, whatever property you're buying, again, it must be a like property, but it has to be of at least equal value or more than what you're selling. Because again, every penny has to go into the other property. You can't keep any of it. None of the proceeds from that sale. You cannot keep it. You keep one penny, again, the deal's off. You now owe taxes on all of it. So, y'all, that's the delayed exchange. Y'all, hopefully that makes sense. And, y'all, so there's a lot of tax advantages, a lot of tax breaks, homeowner breaks, to owning real estate. It's all a good thing. So, y'all, this is why real estate it's a huge business. It's a huge business. One, you've got an asset that typically appreciates in value. So it's a great investment. And, y'all, there's so many, at least for now, there's so many tax deductions and tax advantages to owning real estate. So this is just an awesome business to be in. Just be careful how much of this stuff we just talked about. I would say the only thing you should be doing is just making your clients aware of some of this stuff, but make sure they know to get the specific, you need to talk to your accountant or an attorney or somebody about the specifics of this stuff, okay? So what we went over, you need to know for test purposes, but again, y'all don't get outside your lane. Don't try to become their accountant, because you're going to get yourself in a mess and you're going to be liable for it if you do. Okie doke.